Bex Bright podcast with our host, Chris Richards. Chris, how are you? And what is our
Great.
topic today? What are we going to cover?
Absolutely. We're going to talk about something I did in a webinar just recently, and it's how to master the art of the pitch, raising money from investors, especially in 2025. It's a
All right.
whole different climate than it used to be 2010.
Yeah,
Everybody
let's
getting
let's talk
started up.
about that. And let's definitely talk about that. Go ahead.
Yeah. One thing that I want to at least start off with here is talk about the climate, right? Because nowadays investors are taking less risk than they used to. We were seeing interest rates come down a little bit, but now they've sort of stagnated. And we see this as a business result across the board. Companies are kind of holding their coin purses just a little bit more tighter this year. So, what does that mean for us as startup founders? Well, that means we kind of have to do a little bit more and go above and beyond than our normal fundraising requirements would normally need us to do. And that causes a lot of problem for us as founders. If we can't get access to the funding, we can't keep the runway going. And then, ultimately, you may have to shut the business down or pivot into something that you necessarily didn't want to pivot into. So I wanted to talk about fundraising today because it's something that a lot of people are starting to ask me about as we're starting to go into the spring. And people are having a tough time, Neil, navigating this financial climate. You know,
And absolutely, because certain things that were available before are not available anymore. They're gone.
right?
See ya.
Yeah.
Goodbye. You know what I mean? They're gone. But so we have to kind of look at those specific things and say, okay, they're gone now. What do we need to do now?
Absolutely. So yeah, when I was fundraising, this was around 2015 to 20 before COVID, right? It was a really great fundraising environment, and people were getting their ideas funded off of just mentioning AI. But now that the landscape's changed a little bit, there's a few things that I talked with a few different investors on what their criteria are today. And the number one thing that everyone keeps talking about is existing traction. So this one, if you've been fundraising, you've heard this one enough, right? Investors want to see that people are already using the product or service in some capacity. And what I've been helping founders navigate is how do you build traction even though hey, I haven't finished the product, or I still have more sales and marketing to do. I don't have any early customers yet. And really what it comes down to in terms of traction is you've got to figure out how to communicate the demand of what you're building, and tie that into real life activities. So for example, Tesla, when they first started the Model 1, right, they might not have had a lot of funding at first, but they did pre-orders. If you can get people to pre-order for your product or service, that shows enough demand, Neil, that you can take that to an investor and say, hey, I've got 50,000, 100,000 people that signed up for this thing and they want it. Let's invest in this too. uh the So that's the biggest criteria, is really just having some traction. The traction doesn't necessarily have to be revenue, but have you started filing your patent? Are you in patent pending process? Are you at least interviewing customers even if you haven't made a sale? Have you set up key partners with certain individuals? All those are super key, and it's the fundamentals that I think a lot of founders miss, right? The second piece of what people are really looking for, investors wise, is sustainability. So before pre 2020, right? Companies used to be like cash burning machines. You say, hey, we expect this amount of profit in 3-4 years. We just need this whole upfront bout of capital. That's changing now. And so what you need to be able to do is show revenue models and business models that are profitable nowadays, right? And with the age of automation, AI, you could figure out pretty easily with your business model where you can improve on and communicate that to investors.
So
So
what are investors looking for? What is their bottom line they're looking for if they see that this is a really good service or product and this is going to make a lot of money for them quickly? But yet you talk about the specific differentiators, but how do you finally close them? How do you make
Well,
sure that they're going to open up their pocketbook, or they're going to write a check, or they're going to say, this is worth it?
yeah. Well, assuming all those things are lined up in a row and everybody's excited about it, at its core, investors invest in you as the founder and your team. So I found that one actually to be the most important piece of it. Your relationship with the investor, who you are, your previous experience. It's much easier as a former founder to raise capital in today's age versus you're just now starting. It is a lot harder today if you've just now starting the idea in your garage to try to make something happen. People want to see that progress first. So that's one of the biggest sort of things you need to just start working on it if you haven't started it, right? Aside from that, companies are looking for businesses with healthy sort of balance sheets, not too much operational burn. So you're not hiring too many people too fast, right? Um, showing good customer acquisition costs. This is something founders should know, right? How much does it cost to acquire one client, right? Whether I'm doing podcasting, whether I'm doing tech, you name it, and be able to adequately, express that. And then, do you have a vision and a plan? Really, it comes down to that.
Right.
And do people believe in it?
And so how many investors do you see out there? You think there's a lot out there still that can invest in companies?
Yeah, there's money out here. I think it just depends. I think what's happening now is you need to find more aligned investors as opposed to just a willy-nilly guy down the street who's ready to just sort of invest in your grandiose idea. If you have an investor that really works with you, really believes in the idea and what you're doing, and maybe even has like introductions into that vertical, then that's the type of investor you want to start working with nowadays. This sort
Is
of
it easier for a company that's raised capital enough to go after seed money later, better than one that has not made any money at all?
Yeah, it's much easier because what this does is gives you the cards, give you more leverage and cards for you to hold as the founder. So if I can go to an investor and say, "Hey, I'm already making 20,000 in monthly reoccurring revenue already," I can ask for probably a smaller amount because I don't need the capital. And then two, you have better terms in your valuation. So investors will try to hand you a term sheet. Uh, you'll say, "Hey, Chris, I think the Neil Haley show is worth 10 million." And then the investor says, "No, I think it's worth 5." And you're like, wait a minute. And that's when the true
Right.
negotiation phase really
Exactly. But
starts.
you have to see
Right.
specifically. So when you look at, instead of investing in the stock market, investing things, if you're an entrepreneur that's run businesses and you can run another business, it's better
Right.
to put that in your portfolio and invest in now, and then take the percent of what you're going to make based on what you bring to that founder. And
Right.
what about more investing the business through sales to then improve the product, improve the ideas, to take it to the next level? How many believe it? How much do you still believe in self-funding a business versus getting your own investors?
I'm glad you said that, right? Because yeah, bootstrapping is still one of the best methods really for maintaining equity control of your business over a time period. And um, yeah, I that's what I did with my business. Really, that first few years, first 2 to 3 years, bootstrapped a lot of it, and then when we really found our product market fit and we had early customers and really knew where we were going, then that's when we raised that big bout of capital in order to really grow it and scale it. So that's where you want to find your footing if you are bootstrapping. I think that's a great way that founders should do. And it's becoming easier now. You got all these automation tools, AI, to kind of help you create a lean team. But again, investors invest in founders in their teams. So start thinking about, okay, who are all my star players I'm going to put on my startup basketball team, right? Like I better have my right starting
I got
team.
it. And then if you can't bootstrap, even though you don't want to bootstrap to make it quicker, then you might not have the right business idea anyways.
Exactly. Yeah, it probably wasn't profitable from the beginning if you can't bootstrap it. So that's a one indicator. And then yeah, if you need a whole lot of capital just to make it work, I mean, yeah, that's unrealistic too. So yeah, it should be a nice healthy medium between the two.
So where do you see it? What's better, bootstrapping or not bootstrapping?
I'd say the first 2 years of your business, bootstrap, right? Really get into the nitty gritty, figure out your customer and the product, really understand your business intimately more than just, hey, I got this idea. No, get in the trenches, right? And then once you've gotten to a significant point where, okay, I think I've got a really solid market ready product, then go for your investor dollars, because what investors are gonna see is use of funds, and those use of funds better not be something stupid. uh,
All
and
right. So the best place to go, where can we go, Christopher?
yeah, so you can catch us at uxbrite.com. That's spelled uxbrite.com. And then check us out on LinkedIn and Spotify for these UX Bright podcasts.
All right.